always a pleasure for me to be able to do an introductory lecture to our new physicians. And so with that, I would like to just say that Lester the Investor is how you can get in touch with me if you have any additional questions, and I'm happy to try and take them at any point. For those of you who need a disclaimer and also have a good memory, here is the entire presentation for you in just a few moments. And if you are able to capture all of that, then you recognize that I'm not a financial certified planner. I'm giving you my anecdotal experience over life. Past performance is no predictor of the future. And of course, this presentation does contain some graphic details that may be offensive to you and not suitable for all audiences. Let's go. So I never give advice, I only give education. It's always nice to start off with the movies, and in this case, I'm going to present 6 or 7 different movies to highlight some of the various points that I'm going to go over. And so I do think that seeing The Wolf of Wall Street is a fantastic movie, and in fact, if you look at it long enough, you will see that my reflection will be in that particular movie as you go through the things that you need to decide. 7 steps to financial health. So what I am going to do is go through the 7 different things that I feel are the most significant for you in order to be able to achieve long-term financial success. And of course, the first one is saving enough. The movie for that is The Pursuit of Happiness. If you have a dream, go get it. Never stop, and don't let anyone else stop you from getting it. A great and very uplifting movie. Physicians definitely know how to earn money, but they often do not know how to save money, and this is because we have suffered from delayed gratification. You've waited for so long to get where you are that you just can't wait any longer, and so you get into frivolous spending. And really, this is a major issue when you think about what you have done over your life. All you ever do is delaying whatever it is, if it's high school, college, medical school, residency, fellowship, now as you start out in our organization. So it is something that you need to come to terms with. But planning is the single most important step in order to be able to achieve your goal. And if you don't have a goal, you're obviously not going to achieve it. And all of you have had goals since you obviously got through medical school. And so I would like to encourage you to continue to have that as you move forward. So the people who plan and save actually maximize compound interest to their advantage. So if you look at this in a different way, for every decade that a person delays saving, they really do have to nearly triple the amount that they save. So let's say you are 35 years old and you're saving $1,000 a month, whereas if you are 55 years old, you would have to save $6,200 a month in order to achieve the same long-term outcome of $1 million at age 65. So you can tell that it is a significant factor that comes into play as you look at what goes on with your life. Remember that you must save a little bit more than others, and so you need to save more than 10% of your income in order to be able to survive, because you're high earning. That means you have a high standard of living, and with that comes the associated high expenses, where you tend to spend a little bit more than what you would otherwise. It's hard to always be a resident. You also have delay in savings. You started saving probably 7 or 10 years later than everyone else that you started your high school experience with. And this is because you've had years in medical school, you've had years in residency, you've had years in fellowship, and of course this means that you have less time to accumulate or compound your assets over time. So with that idea of compounding, let's just say that you have 2 magic pennies and every day they multiply by 2 or double. So how much money would you have at the end of 31 days? Well, I'm not going to belabor the point for very long, because I'm sure that you could pause the video and calculate it out on your own. But let me just say that it is more than $21 million. Now, clearly, this is not something that we're able to achieve in any given moment. But as you look at compounding tables of interest rate returns, and if you look out for a single $1,000 investment at various interest rates between 10, 20, and maybe even 30 years, you will see that that same single one-time investment really does have an incredible compounding over time, to the point where you can have $5, $10, or even $17,000 at the end of a 30-year time horizon. And that's really the time horizon I would like you to focus on as you think about what it is that you can achieve in your long-term savings for retirement. So anytime you have money to put away, if there is a plan where you have employer match, that is the one to do for sure. Now, the reason why I say this is Kaiser does not have an employee match, but it does in the sense of our common plan, which I'll get to a little bit later on. But this is for those of you who have spouses or significant others. Just have them recognize that anytime there is an employer match, they need to participate in that program. Anytime there is a pre-tax or tax deductible plan, that's the next best thing. And then, of course, anything that is amazingly worthwhile that is non-deductible but still tax deferred. And all of those tax deferred plans are things like IRAs, Roth IRAs, single Ks, or Roth 401k, which of course we do have in our plan. So if you think about what goes on over time and looking at the difference in what you would have, if you put the same amount of money, and this dollar amount of $57,000, by the way, is the amount that you are allowed to put in maximally into retirement accounts presently. I've used a modest 6% return, 35% federal tax rate, 9% state tax rate, and an inflation rate of 3%. But you will still see, taking all of those considerations into this calculation, you still will have nearly 390% more money at the end of the duration of a 30-year time horizon. So again, the tax deferred versus taxable really is an amazing difference that you must take advantage of in order to be able to succeed in the retirement game. So when you think about it, there are actually quite a few differences between the sexes. You will notice that not only is there income differences between men and women, but there is also a difference in how much the individual sets aside, how much they have in aggregate balances, and of course what the life expectancy of that particular person would be, as well as overall healthcare costs. So with that in mind, you will see that women tend to not participate as much as men, and therefore their dollar balances are lower over time. Let's look at participation within our own group. So this is actually within the SCPMG group, those that are in the plan versus those that are not in the plan. You will see that obviously the men who are not in the 401, this means they're just in the KEO plan versus women. You will notice it is a substantially lower rate for the women that are in our overall group. Those that have tenure in the plan, it's about the same for everyone, ever so slightly less for the women at 11.6 years. But they are much less likely to use a managed account. So this means they are not seeking advice from someone else when they are not participating in the 401. So you'll see nearly a quarter of the people do get advice of some sort when they are participating in the plan versus only about 16% or 19% with the women. Now, the one thing that is quite interesting to me is that those who are married are much less likely to be involved in the 401k plan. So what this tells me, especially with the significantly higher amount in that of women, is suggesting to me, again, that they are deferring to a spouse or significant other and saying, oh, they'll take care of me, I don't need to worry about it. But this is really not the case, and everyone needs to take their own accounting into consideration, of course, including the partner in the decision-making, but not deferring that to someone else. When you look at the new hires, this is the people hired into the group over the last several years, and this is specifically around the KEO, you will notice that we have about an equal number now, 441 and 412 between the new hires for male and female, which is great. But you'll notice that those who are not saving anything in the KEO plan is higher than what it is for the general population, and even more so for females. Again, those who are not participating in the 401, we have 23 and 24% respectively. Now, the one good decision making by women when they do elect to participate is that they are choosing the Roth option within the 401, which is a great thing to have done. But still, you can tell that there are differences in the new hires over those that have been in the group a long time, as well as between males and females within our group. So who saves the most? I'm so happy to say that it's pathology. Yeah, this is the only time we'll be in that position, so let's just move on to the next thing. When you think about your key factors for saving, longevity, inflation, withdrawals, healthcare, asset allocation all make a huge difference. And of course, there are also generational gaps. So if you think about the year 2000 versus 2015 or 2019, 2020, you will see that there is quite a remarkable difference between life expectancy, people who have higher education, people who are employed, the binge drinking concept, smoking, etc. And so when you look at this heat map showing where people have the most likely to live the longest. People living in Singapore and Japan and Monaco are actually the people who have the longest overall lifespan, but you can tell that the United States is right here in the upper portion of this graph. There are differences in age of decades worked as well. So when you think about someone in the 1950s, they only had a 8-year retirement length, with about 45% of them continuing to work with an average Social Security benefit of only $280. Whereas if you look at that several decades later, you can now see that people are living 17 years in retirement. Only 22% are working, and of course the Social Security benefit is substantially higher. So this just means you do need to plan for a long time horizon. When you think about that, here is a combined timeline analysis of a 65-year-old on his own has about a 50% chance of making it to 87, whereas a 65-year-old woman has a 50% chance of making it to 90. However, if you are married and living together, you have a 50% chance of reaching 94. So this does tell you that if you have a stable relationship and one that works well for you, you're much more likely to live for a longer duration. So let's talk about inflation a little bit for a moment, and that is if you have $100,000 now, how much would you need in equivalent dollar amount to have purchasing power of the same amount 25 years from now if there was a 3% inflation rate? So I'll let you think about that for just a moment, but let me just show you that the average amount at that particular point would actually be $215,000 a year. So this means that even though you are saving a significant amount, remember that over time there is an erosion of the purchasing power, and therefore that dollar may not be as useful as you move forward, and therefore will be much more challenging if you just have the same dollar amount. So you need to recognize that inflation, even at a low rate, is certainly going to play a role in your long-term savings. So let's just show a few things related to the risk of inflation. This is just showing a few average items over several decades of time. And I think what I would like to highlight is that you could purchase a house for $12,000. I mean, that's your rent nowadays, just for a single month in a one-bedroom in Los Angeles. Okay, just kidding, but I mean, it is super different than what it was in 1958. You can also see a tremendous change in the overall value of cars. And of course, I've put non-applicable for stamps because the Postal Service is going out of business. And by 2028, maybe no one will be using the Postal Service any longer. I'm putting up a health statement, and actually this is from my mother-in-law. She didn't give me permission to do so because she is now dead, and I guess the dead have no rights. And so here I am showing her hospital bill from 1972. So she was actually admitted for a cholecystectomy. And what I would like to highlight is, look at this, the daily room charge of $74. Can you imagine? So this is just to highlight how really amazingly different what you have now and what we had back then as far as the overall costs of items, and especially with healthcare. So let's talk a little bit about healthcare, right? So if you think about healthcare costs, they've risen amazingly, and they will go significantly higher when you are in retirement. And in fact, it's estimated that $190,000 is needed during the duration of someone's retirement for healthcare coverage. Now, if you are within Kaiser, obviously you would be covered by our healthcare plan, and therefore this is an amazing benefit that you should not discount at all. And if you also think about it, there are going to be differences in long-term healthcare depending upon where you live, with the lowest rates in the Southeast and the highest rates in the Northeast. Let's talk about a few numbers that you need to live by. So if you think about it, 95 is the age that you should use and plan on living until for your retirement. And if you retire at 65, that's going to be 30 years. 80% of your pre-retirement income is needed for you to meet your same expenses in retirement. Use an average annual rate of return of 6%. Use a maximum withdrawal ever from any of your savings accounts per year of 3%. And finally, use 3% as an annual inflation rate just as a guide. And clearly, these are just guides or things to live by. But I have found when you're doing calculations, when you're trying to do simulations of where you are and what's going on, these particular numbers really suit you well in order to be able to get meaningful evaluation. Let's go on now to good debt management. And I know that this is a significant thing for all of you. So when you think about a movie for that, Margin Call is actually great. This is actually a movie about the 2008 financial crisis, and it is just the 24 hours where one of the leveraged banks began to have the failure. And it really is just a remarkably well done movie. College debt, medical school debt, all of your loans, practice costs, high balances on houses and cars. When you think about the average medical school debt right now is just under $200,000 here in the United States. So I'm sure many of you have the same amount of debt. And in fact, when I've spoken to some of you, it is in the 250, 300. If you have two people who went to school, 400. So the amount is truly an astronomical amount. This is all related, of course, to leverage and a high interest burden. And so let's talk about that for a moment. So here are some average salaries across the nation. This is not Kaiser specific data. This is just across the nation. And I am just pointing out that these are the averages. So, I'll put in pathology here because our average is 286, just as a point of reference. You can find your own amongst that list. But what that means is most of us are paying off some sort of debt. And whether that debt is a mortgage on a car, on a house or on a car, certainly paying off medical school debt is one of the huge numbers that affects all physicians. And you can see that a third of people are paying off debt at any given time. So who is actually paying off their medical school debt? Well, you can tell that as a percentage of the overall physician group, it is a fairly remarkable number who are all paying off some sort of debt. Again, just highlighting pathology at 28% because that's my area, just to show you where you may fit in this particular paradigm. So 1 in 10 borrowers who started paying their student debt defaulted. It's the highest default rate in the last 14 years. And part of this is because anytime you earn over 70,000 or 145 if you're married filing jointly, your interest is no longer deductible. Now, I will say with COVID, there has been a remarkable number of bills introduced into Congress. Of course, with the friction, and not many of them have passed, but they are still present and being evaluated in light of COVID-19. So if you do have significant medical school debt and are trying to see what the best thing is to do, there are certainly going to be some options potentially available for you. So keep an eye out for that moving forward. So how much is the loan? Is the interest rate flexible? Is it fixed? Was it deductible? Did you start paying it off or not? Have you already consolidated? Did you pay interest while you were in residency? And all of these particular factors come into play. So if you think about it, if you have a 30-year time frame in which to pay it back and your interest rate is fixed and it's less than 4%, given where we are with present taxes and inflation, that means you should pay that out over the full term of the loan. And the reason for this is, well, inflation, right? So just as I said earlier, if $100,000 nowadays would require $215,000 25 years from now to do the exact same thing, that means you'll be paying back your loan with a reduced buying rate dollar, and therefore it is a prudent thing to do. Now, psychologically, it may not be, but just recognize that if you do have loans that are fixed and at a low interest rate, this is a great option to do. Some of the impact just on your savings, I've taken $175,000, 6.8% as an average interest rate instead. Your payment would be about $1,200 with interest representing just under $1,000 of that if you started paying back in the first year. However, let's say you just went on for 4 years of residency and paid nothing. So you may say, oh, look, it only went up by $300. Yeah, it went up by $300. But if you take that difference out over time, you ultimately would have paid another $95,000 over a 25-year time frame. So even though you think the deferral may not have had a consequence, it definitely does. So these are things to consider. And certainly now that you are in practice, that residency type question may not be in place, but it certainly may be if you think about it as it relates to a spouse or significant other. This raises the question, of course, of consolidation or not. And of course, there are a number of factors that come into play with that particular question. We do have a great plan with First Republic or Common Bond. These are two organizations that are working through Kaiser to be able to do loan consolidation. They, in fact, give a great rate. You can see that their current rates based on APR are actually in the 2 to 5% range, of course, depending on exactly how much the loan is and what your value is. And here are the two people that you can contact directly in order to make any decisions around loan consolidation. But it's a great program within Kaiser that will allow you to aid in that decision making. Let me just say a few words about college savings plan. As you know, college costs a great deal, and of course, children will come along, and planning for their college expenses is certainly a useful thing to do. The 529 plan is excellent. It allows you to put money aside as a tax-deferred accumulation. It will cover the costs of tuition, supplies, etc., and you can contribute up to $400,000 as the total amount, maximum of $30,000 per couple per year. And interestingly, now you can actually use that money not for college, but for grade school. Yes, for grade school. You can use up to $10,000 a year if you're covering the cost of grade school. So COVID, right? This is, of course, the bear in the room at the moment. And when you think about what you're doing in coping with financial crisis, this is certainly a time when having an emergency fund is significant. You should have somewhere between 3 to 6 months worth of living expenses, and they need to be in some sort of cash vehicle that's easily available. Now, I will tell a short story about myself and what happened during COVID. So I don't like having money under the bed, so to speak. I prefer to have it in a bank. But with COVID, the banks closed. So any of you who use banking locally, it was the Bank of America at the corner of Topanga and Burbank, and that actually shut down completely, and therefore I would not have had money. Now, my wife thinks differently than I do, and she had money under the bed. I mean, not really, but it was money in the house. So we actually had cash readily on hand without having to rely on going to a bank. If you had asked me this question 2 years ago, I would never have thought that a bank would physically not open because of a national crisis. So just be aware that this needs to be in cash and maybe literally in dollar bills that you're counting out. So changes are always inevitable, right? Marriage and children, changing jobs, divorce, disability, death, presumably in this order, but not always the case. And so just recognize that those changes do take into consideration major national events as well, which will make it difficult for you to plan long term. And with that in mind, though, budgeting comes to the forefront. Where do you have any sort of budget? I mean, a lot of people say they have one, but in fact, only about 1 in 5 physically use a budget. And budgeting really is just planning, right? It's just a means to an end. It's helping you to establish a guideline or a goal, helping you to organize what's coming in and going out and where you're spending your money. Now, there are a whole bunch of different services available. I'm highlighting just a few of them here. I personally happen to use Mint. It is created by the Intuit company, and therefore I do trust the overall aggregation service that it relies upon. But any of these budgeting methods will allow you just to keep track. Now, I'm not saying that you need to do this long term and that you need to work on it as perhaps religiously as I do. But suffice it to say that having a reasonable approach to what you're doing with your money and understanding where it comes and goes will make a difference in how you actually spend it over time. So a quick budget is kind of the 50, 20, 30 rule, 50% for essentials, which include, your groceries and mortgage, utilities, phone, that sort of thing. 20% for savings, and then 30% for various lifestyle choices. And of course, this is where you go out and eat and go to restaurants and entertainment. Now, I think part of your 30% lifestyle choice is paying back your medical school debt. So that is probably a little bit of a different number for most of us. There are a number of mistakes that can be made when you look at credit cards and their usage. I'm not going to read all of these to you, but just suffice it to say that overspending, holding too many credit cards and not paying off the balances at any given time really does make a huge difference to what you have as your credit card balance. So if you think about debt ratios, there are a couple of good rules of thumb. The 28% rule and the 36% rule. So these, of course, do not take into consideration your own personal circumstance or where you live, but just use them as a general guide. So the first one, 28% ratio. Your total housing cost should not be more than 28% of your gross monthly income. So all of these things are related to the mortgage and taxes and home insurance and HOA and maintenance and earthquake coverage and everything else. So it really is just related to housing. And then if you expand that slightly, the 36% ratio is only giving you another 8% really of additional debt. So these are the other things for auto loans, student loans, credit cards, etc. And this is where it's really difficult for people in medicine to survive, because many times the medical school debt is quite significant, and therefore that ratio is going to be difficult to maintain. Before you buy anything on credit, though, always ask yourself, what is the cost of it, what's the risk, and what's the obligation of the credit? And if you do that, you should be able to keep yourself out of trouble. So shopping for a good credit card with the best terms, a low annual fee, no annual fee, rewards program, allowing you to pay bills on time, that you don't max out your credit cards, etc. So these are just rules to keep in mind as you approach credit card debt in general. And one of the other things, of course, is how much should you be paying? So if you look at the percent of monthly balance that you pay off, and these are actually numbers taken from several of the major credit cards that on average now have an 18% annual interest rate, right? So you're only getting 0.001% on your checking account as interest rate, and yet they're still charging 18%. Still, if you look at this, the amount that you pay off is definitely going to change how much you have to pay over time, with interest rate accruing over the balance time period. So it is far better to pay off all of your debt for credit cards as you accumulate it, rather than trying to have it aggregate over time. It's important to know your credit score as well. 3 major companies. If you want to use any one of them, going to annualcreditreport.com would allow you to get a free credit report from each company each year. If you're married, you can actually get a free report then every 2 months, because I could get mine from Equifax this month. My wife in 2 months could get it from TransUnion. I could get it from Experian 2 months after that, and then she would get it from Equifax, and and you would just keep rotating through and clearly be able to get constantly updated information. These particular scores are broken down into a FICO score. As you can see, 35% of it is made up of your payment history, and 30% made up of the amounts that are owed. And in average for the United States, there's a range of around 678 for a FICO score. So it is something that it is important to keep track of, so that you know, because everything is determined by that score. The amount of your interest rate for a home loan, all of these things are accounted for in that regard. Okay, let's move on to being tax savvy at this point. And I know The Shawshank Redemption does not appear to be a tax movie. However, the lead character was giving advice to the prison captain about spousal gift tax exclusion, which set in motion his ultimate freedom. So it's a great movie, and I would recommend it whether you want to look at the tax savviness side of it or not. So the tax code is amazingly complicated, right? If you look at the number of pages that are included, and this is not just the number of pages, but also the instructions that are included in it, it is an amazing number. And there really has been a 187 times increase over the past 100 years. Looked in a different way, the Internal Revenue Code would fit on 80 rolls of toilet paper. And since that was the first thing to go during COVID, I could not resist that particular analogy. When you think about where money goes from what you pay in taxes, I thought it would be nice for you to see that about 50% of it goes to the major entitlements of Medicare and Social Security. However, when you think about what happens with education, which is what every single political pundit speaks about, it's less than 1% of the overall budget. So it is truly a minuscule amount that goes into that particular group. If you go to the usdebtclock.org, you will see that there is a remarkably fascinating site that keeps track of what is going on with all of our taxes. And in this particular case, I think it would be quite easy for you to see that 27 trillion is the total amount at this juncture. So let's talk about taxes for a moment. The top 10% of people paid 71% of federal income taxes. They earn about 50% of reported income. So what is that top 10%, that truly ultra elite group? Well, it's anyone earning more than 118,000. So ladies and gentlemen, that would be you. That means the top 1.5% is anyone earning $250,000, and I suspect that given married filing jointly status or time within the group, you will soon be within that group yourself and recognize that you really are in the top 1% of the nation as far as overall earning. So where does the wealth creation come from? Well, you can see that the upper middle class is really increasing, as are the super rich. you will notice that if you look at the super rich, it's someone who's earning more than $350,000 a year of income. So again, if you combine income between two people working, one for Kaiser, let's even say two for Kaiser as physicians, you can really tell that this is going to be a major way of creating wealth. And in fact, if you look at this a different way, there is 1 millionaire created every 50 seconds within the United States. How do these people get rich? Well, education and hard work, and you've done both of those, so you should get there as well. You will notice that if you look at compensation by geographic area, the West, which is where we are, has about an average salary of $300,000 per year. So who are the richest physicians? Well, I'm not going to list off all of the people, but I again will point out that pathology is not in that group. So we are not the ones who make a boatload of money. But this is an interesting point of comparison. Those who have never made an investment mistake. Now, clearly this is self-bias and self-reporting, but if you look at this, pediatricians state that they have never made a investment mistake, whereas only about 40% of urologists say that they've never made a mistake. However, if you now look at the overall net worth of individuals and you look at urology, you will see that the urologists are way up there at the top of net worth, even though they are the ones that claim to make more errors. So what this means, if you look at that in the reverse with the pediatricians who are way down at the bottom and also claiming to have never made a mistake, it means you are going to make mistakes. So if you want to make an omelet, you got to break some eggs, as is stated from one of my favorite movies. So just be aware that you do have to recognize that mistakes will be made, and as long as you learn from them, you're going to do well long term. So the marginal tax rate looks very much like an EKG machine if you look at it out over time. And in fact, right now we're at about 37% as the maximum tax rate. But you can tell that this really does have a remarkable ability to change over time. So you need to be tax savvy. You're going to have higher earnings and therefore you're going to have higher taxes. And there are a number of things that you can look at with tax shelters and tax breaks and IRAs and someone who can help you with all of that. And that's probably one of the most important things, is to get to know someone who's able to assist you with what you can do. Tax allocation allows you to protect your assets, and when you think about this, bonds and REITs pay out interest and dividends, and therefore they should be placed in a deferred account, whereas if you think about stocks that have capital appreciation, they should be in outside investment accounts. Remember that when you die, unrealized capital gains disappear and they have a stepped up basis, so this is just something to use for estate tax planning purposes. So having a tax preparer is significant. Get someone who does the taxes for you as a flat fee, not per form. Don't do it yourself. My most recent tax return was 117 pages, and even though I read through it, I'm still not certain I understood all of it. You know, we're physicians. We're not tax preparers, and the laws change constantly, and therefore you need to have someone who is familiar with them complete that for you. Just as a caveat, once you make partnership, you will have to make estimated tax payments yourself. And it doesn't matter when in the year you become a partner, you're still going to be responsible for doing it. So I may not be giving a lecture to you as a new partner until well into the year, and therefore April 15th, June 15th, September 15th, and January 15th are the dates that you need to recognize and realize that these are ones that are going to be important for you moving forward. So there are a bunch of different tax contribution types. In the 401, you can have pre-tax, Roth, and traditional after tax. And of course, with an IRA, traditional and Roth IRA, which is after tax as well. So the 401 does not have any income limits, whereas the IRA does. And the reason I'm saying that is I'm going to highlight a little bit about the Roth 401 here for a moment. So if you think about the traditional and Roth 401s, we have a 401k that allows you to make pre-tax contributions, reducing your current taxable income, tax-free accumulation, but of course, you will pay tax for it when the money is withdrawn at the end. If you look at this differently now with the Roth the Roth IRA, this means that you make contributions after tax. It will have tax-free accumulation, but the distributions are now tax-free without any minimum required distributions. So this is really a significant difference when you think about what goes on with your retirement planning, and being able to have a Roth as well as a traditional 401k gives you a certain amount of flexibility in retirement and in your estate planning. And of course, you can contribute to either or both of these. There may be some benefits specifically for the Roth 401. This means that if you're paying lower tax rates now, if you're just getting started, if you're financially well prepared for retirement and you're contributing the maximum amount, then the Roth 401 is definitely something that you should consider. So here is a summary of what goes on, but let me just put this diagrammatically first. And that is, if you were to put money into a Roth and not save the differences, and this is the same amount, 35 years, 19.5, which is the maximum amount, 6% per year, including the catch-up, you can see that you would actually have a remarkably increased amount of 611,000. However, if you took the difference and invested that separately now, because remember, the Roth is done with after-tax money, so if you took that tax break of a pre-tax 401k into consideration, and now looked at what the returns were, you can still see that you would be about 200,000 ahead with the Roth over time. So it really is a significant benefit to you, no matter whether you're saving the money difference or not, that it really is going to be a huge overall benefit to you. Let me just say that the traditional after tax, you have to have already worked for 2 years. You can convert it later on, and the maximum amount you can put in is 37.5, which is really something that is equivalent to the KEO. And I'm not going to talk about it much now because you're just starting out and therefore would not yet have met the 2-year requirement. So if you think about what goes on with the overall plans that we have to offer, the KEO allows you to make 37.5 as a contribution. Your pre-tax or Roth is each 19.5. The traditional after-tax is the 37.5, and your annual contribution amount is either 57,000 or if you're older than 50, 63.5. And so you can see that this dollar amount is equivalent by incorporating that after-tax if you have a zero contribution to the KEO. So if you have, for some reason, made an election not to participate in the KEO, this particular after-tax traditional contribution allows you to sort of catch up for having made that decision. Let me just highlight a few points to remember. You can elect the Roth 401 at any time. There is no income limit. So this is different from the Roth IRA, where there is an income limit for you to be able to contribute. This is a Roth 401k, and therefore there is no income limit to it. All are eligible to participate. You can switch in and out over time, and it doesn't make any difference to what you do long term. So if you're less than 45 years of age, you should probably be 100% in the Roth 401, depending on what your other circumstances may be, but it does give you a great variation of what you can have in your overall tax preparation. So a lot is at stake when you think about overall tax planning. There's about $8 trillion in 401k plans globally. And if you think about what we have within SCPMG, we have the 401, the KEO, and the common plan. So let me just point out something about the common plan, just so you've heard about it. It is a defined benefit plan requiring 10 years of service in order to be able to be vested. And then a calculation is done based on what your highest average compensation is, with about 8 billion held in that particular account to make sure there is enough to pay out over time. So that calculation gives you a annuitized benefit that begins at age 65 and goes until you die, or depending on how you calculate what your payments are going to be. But needless to say, this is an amazing plan that really is not available in very many other plans around the nation. I bought insurance on my parents. I did not love them any less because I was going to get insurance on them. I was not going to kill them. I had an insurable interest, and they were willing to do the physical blood test in order to be able to achieve it. And this means that because I am the owner, I will have tax-free income paid out to me after they have both died. So this brings up the point of being adequately insured. So first of all, let's just show what the movie is here. Double Indemnity is a fabulous movie. It talks about planning a murder where if the person dies on a train, there's actually a double payout from it, and really does have a very interesting plot twist. It's a black and white movie, but it's a great one to see. So if you think about insurance, it's really a safety net, right? It's putting some sort of risk management on a whole variety of different losses that you can come across. And here there are a whole lot of them. I'm not going to highlight all of these. I'm just going to talk about life, umbrella, and liability for the moment. Life insurance, as you know, comes in two flavors, term and cash value or whole life. The cash value or whole life is what is paying your insurance agent his income, and therefore is a completely meaningless thing that you should never be involved in because it is just a complete racket. When you think about, of course, that is just my opinion, but it is still that way. When you think about how much you should get, circumstances will vary, of course, but in general, in the early years of life, having somewhere in the range of 8 to 14 times your annual income. As you get older, less, and then, of course, after 65, it depends on what your circumstances may be. But just remember that it depends on the number of dependents you have. What are you paying for? Who are you trying to support? What are the income needs of a surviving spouse or significant other? And therefore, shop for low premiums. No matter what, you can usually get a good rate somewhere online, and this is some beneficiaries are required on all these type of accounts. Clearly, your will is not going to have any jurisdiction. You should name a contingency beneficiary. Retirement accounts are each unique trust accounts and therefore must have their own beneficiaries as well. And of course, if you name a minor, you're going to guarantee that it's going to go through probate. And just remember to change the beneficiary as your circumstances change over time. If you work for Kaiser, you're going to have healthcare coverage. It doesn't really matter. It's going to be covered, but just recognize that COBRA may be important if you leave. This is coverage that goes up to 18 months afterwards, but it does come at a price. Kaiser does have disability insurance. It is specialty specific. There are elimination periods and all that sort of thing that go into it, so certainly look into it. But I do believe that the disability coverage that we have is quite sufficient no matter what your circumstances may be. Now let me talk about umbrella insurance for a moment. When you think about this, this is personal negligence. And when awards are over $1 million or more, the average award is actually $3 million. So this suggests to me you should have $3 million in coverage. So why should you have umbrella or liability insurance? That is because you have an MD or DO or DDS or DMD or whatever it is after your name. And when someone sees that, they see dollar signs. They do not see the degree. And so as they come up to your home, trip and fall and sue you for the fact that they fell is because, oh no, it's got nothing to do with you. It's your insurance that's going to cover. No matter what, you need to have sufficient personal liability insurance that covers your assets no matter where they may be. And in general, these policies are somewhere in the range of $500 to $700 for a $3 million policy. They're generally issued through a company that already holds insurance for you, whether this is through homeowners or auto or something else. Just be aware that this is a significant coverage gap that you need to have in order to avoid the frivolous lawsuit. Now, I wasn't really going to talk about professional liability because, of course, this is for errors of medical omission or commission, which is covered by Kaiser. But it has come to my attention that people do not understand that they do not get coverage for criminal acts. So if you do any sort of assault or battery or attempted rape or unwanted sexual contact with a patient, or you drive while intoxicated, or you forge something, or you're involved in any sort of burglary or arson or larceny, this is not covered by your professional malpractice. Don't do these things. Okay, let's go on now to wise investments. So Boiler Room is a great movie. It talks about how these brokers tried to cheat customers out of their money by selling them worthless penny stocks, but then ultimately they ended up having the stocks backfire on them as well. And therefore, if an investment sounds too good to be true, you should probably run for sure. So anyway, very fun movie to watch, and I would recommend it. So what do you think you know that the average person in the market does not know? Well, let me just point this out as a finding here. So this is a sonar that was sent out as a weather map right over Hesperia earlier this year. And it was viewed to be a flash storm, except people in the area were like, well, it's not raining. So what's going on? But the news kept saying, no, there's flash flooding, there's flash storming going on. Well, actually, if you went outside, you would see that this was nothing more than a huge swarm of insects. And in fact, they were all ladybugs. So sometimes what you think you know and what is actually happening is not at all related. And so everybody is going to try to sell you an investment of the most exotic and convoluted type, especially your patients. And they are going to say, oh, doc, I work at Amgen. Let me tell you what we do. No, this this is a crock of bilge, let me just assure you, because everyone at Amgen knows what is going on, including the investors outside. And so keep it simple. If you do not understand what the business does or cannot explain it to someone else in 60 seconds or less, drop it and run screaming. Avoid medical adventures. Now, I'm not saying this because I think it's a bad idea. I mean, I think some of the best stocks out there are in the healthcare industry. But just because you're in the medical profession, do not think that that means you understand it any better than anyone else. And the other way to look at this is all of your eggs are now in one basket, right? If you're investing in the healthcare industry and you work in the healthcare industry and something goes wrong in the healthcare industry, oh, wait, COVID. Okay, just kidding. This could be a really, really significant impact on your overall savings. So just think about what it is that you're doing, because good diversification is going to be important for you. So what to invest in? Well, you never time the market. Indexing is going to be fantastic and something that you need to do, and then kind of remonitor what's going on. So I'm going to show you what time in the market versus timing the market will do, and this is just an average 20-year time horizon, where you will see that if you were in the S&P 500, you would have had a 7.8% overall outcome, whereas if you were out of the market for the top 5 days that were the best performing, you would now go down to 5.6% and slowly down with the out of the market for the best 20 days as 1.7. Let me put this a little bit differently. The overall average return, if you look at the total amount, you would have had a 351% market rate return if you were just in it the whole time. If you tried to time it, however, and you happened to miss the top performing days, you would have had a return that dropped down to 200%. And if you look at the value over time, you would have had 43,000 at the end of the time frame if you had invested 10,000 versus 29,000 if you were out just the top 5 days. And I'm going to show you a graph in a moment. That top 5 days could be anytime, anywhere, without any sort of knowledge of when that is going to be. So recognize that portfolios work over time, although they do not work every single second of the time. And this is why diversification works well for you. So I'm not suggesting that you now start a different practice, but just recognize that this is one of the models that can be used. So diversification allows you to spread money across multiple different investment tracks and reduce the overall risk by picking from a group of investments. So let's talk about the investment pyramid. You can see that things in the lower quadrants are those that are the most secure, while as you move up in the pyramid to things like gold and collectibles, stocks and future contracts, these really are quite remarkably different and therefore are much riskier. So if you look at rates of return over time, this is the S&P 500 over a almost 100-year time frame. If you look at that, you can see, again, this looks like someone in VTAC, right? However, if you now superimpose upon that the return of the Treasury bill, you'll notice the Treasury bill, while still positive, is really still moving around over time. And if you then add in bonds as the orange number, you can see that everyone thinks bonds are so fabulous, but they do actually dip below and have a very equivalent overall variability. So just recognize that there is going to be a significant risk over time. If you look at market volatility and see these huge plunges and increases, if you then take that into context and put it in the overall movement over time, you can see that it really is just a small blip in the overall market. So let me point out what has gone on just recently. So if you look at the top 7 changes in the Dow by point changes, all of them have occurred in 2020. So not only have we had the most amazing one-day returns, we have also had the most amazing one-day losses. And if you look at this, all of this occurring in less than a 6-month time frame. So ladies and gentlemen, you and I have no idea how to time the market, because I can guarantee that you would not have been in the market on the right day. And just to point this out, on the 13th, we had one of the highest returns, and on the 12th, the day before, we had one of the lowest returns. So this just goes to prove that it does not matter when you think the market is going to do well, it's just going to happen. So when you look at risk over time and do kind of the best and worst performances over a duration, you can see that stocks are represented in the top, and you can tell 54% was the best year, minus 43% was the worst year. But if you look at averages over time, you will see that over a 20-year time horizon, stocks have in fact never lost money. They have a worst performance of 3.1% averaged out over 20 years, but still the best performance was 17.2%. So this tells you that over time, you're going to have a good overall outcome. This also depends on how you asset allocate, the far side demonstrating completely in stocks versus completely in bonds. And you can tell that there really is a remarkable difference in how you do over time, balanced out depending on how much you have in each of these holdings. So asset allocation, dollar cost averaging, tax deferral, time, type of investment, etc., are all quite significant. But the single most important thing is your asset allocation. What you put your funds in determines what you have as your overall performance outcome long term, and in fact accounts for nearly 90% of the overall portfolio performance. So the asset allocation is going to be dependent on what your risk tolerance is, what your goals are, and what your time horizon is. So don't ever let someone tell you what is best for you until they have sat back and listened to your entire story. What your circumstance is, what your goals are, what your debt structure is, whether you sleep well at night. All of these factors must be taken into consideration if you're going to understand what goes on with asset allocation. So here is an example of asset allocation, and you can tell that the colors, and this is referred to as a heat map, the colors each represent a certain type of investment. And you will notice that without exception, not a single one is present in the top in any given year repeatedly over time. So this tells you that each of the different holdings are going to do differently each year. And so if I look at this particular finding, and I've highlighted the AA, which stands for an asset allocated model that is good, you can see that that really truncates and narrows what your return differences are. And therefore, this is a way in which you can reduce your overall debt to your overall risk. So when you think about what your risk is going to be, you're diversifying both within category as well as amongst categories. And so one of the things that you can do to achieve that is to do index funds. So index funds in general have a very low expense ratio. And in fact, you can see here, the expense ratios within our accounts are less than 0.05%. So they are a really, really remarkable low expense ratio. Just all of these factors come into play with investment psychology, and that is the default choice option. So when you look at the default options that are available, 96% of people will remain into whatever that option is. So this means they don't ever go into their account and they don't change anything either. It is truly a remarkable phenomenon. This also contributes somewhat to what happens to people if they get in and out of the market. And this means the average investor usually does worse than the overall market because they are not in it for the same length of time. So stay the course no matter what. So being a gym member doesn't get you in shape, right? You actually have to work out and work at it in order to be able to do well. So there was an interesting study based on jams, and it was done by a grocery store where they had 2 tasting sessions. One had 24 choices, one had 6 choices, and then they looked at how many people bought jam afterwards. Well, on average, when there were only 6 choices, 30% of people end up buying jam, even though they still tasted the same number. So if there were 24 choices, they only tasted 2. If there were 6, they only tasted 2. So what this tells you is that there is a choice overload, and this results in paralysis by analysis, perhaps, but you're paralyzed into indecision. And so if you look at what goes on with the number of funds offered, the more funds you have available, the less likely you are to have good participation. And so there is a sweet spot, which is in fact where Kaiser has our particular investment choices. So within our accounts, we basically have 14 and 15 choices respectively between the 401 and the KEO. And this allows us to have an excellent diversification and still giving investment choices. So on average, the physicians in our group have about 4.46 funds, which means they're selecting an appropriate number. Now, you may wonder why 1 at the bottom is such a high number. Well, that's because nowadays we do have the option of the target date fund, which is what I'm going to talk about here next. So the target date fund, as you know, is a way in which to designate a specific date at your retirement, and then through risk-appropriated investment, reduce your overall risk over time and reallocating and readjusting the balance without you having to do anything about it. So it is a hugely diversified mix across all of the asset classes with more than 20,000 different individual holdings. And with each of those particular dates, they all have the same investments, but it's just a different allocation to each of those investments. And so in essence, you're getting a completely well-balanced meal over time, which is exactly what you would like to have. So if you think about the equity and the fixed income, well, within the equity, they have core holdings in real estate, and they have international and US and large and mid and small cap and value, growth and value and blend. So it really is a fantastic blend between all of these particular asset classes in order to be able to give you a good mix. That is then set on a glide path, which is a carefully managed and planned shifting in the amount of assets over time so that at various points you have the appropriate amount for yourself. So you will notice if you look at the far left-hand side, this is where you're starting out in your career. And then as time moves along and you get closer to the point of retirement and then even out beyond the early phase of retirement, there is a gradual decreasing in the amount of holdings within each of the various classes so that ultimately you do have the best overall blend to maintain yourself throughout. Fees are always significant for any of these type of investments, but you will notice the average target date expense ratio is 0.91%. But within SCPMG, we have a fantastic rate of 0.04%. This is truly exceptional in the industry, and you will not find this anywhere else. So let's talk a little bit about how things change over time. So I took a few pictures of people from the 1990s, myself included, and then aged them respectively over their lives. And I think you will see that there has been quite a remarkable change over time, including the COVID bearding for myself. However, if you think about this in your investment strategy, what a difference 30 years will make in your returns. So really give this some remarkable consideration. Excitement and expenses are always your enemies because fees will definitely add up over time. So if you took the difference in value of a $300,000 investment between a 1.08 and a 0.08 expense ratio, what do you think that particular amount would be if invested at 6% over 20 years? Well, here you can see what the returns are, and you will notice that there is a $366,000 difference, or 30.7% more over the course of that particular duration. So really, again, just the expenses, when you look at the overall outcome, are a massive contribution to what your overall outcome will be. This is a very interesting study put out by the New England Journal of Medicine, and in fact it was done as a ratio of people eating chocolate versus Nobel Prizes. And I think what you will find to be quite interesting and significant in this case is the fact that Switzerland, right over here, has the highest per capita consumption of chocolate, but they have also had the highest number of Nobel Prizes per 10 million population. Now, do you really think that this is a legitimate finding and that all of us should go out and start consuming more chocolate in order to receive our Nobel Prize? Well, of course not. But what it does highlight is that you need advice, of course, is one of the keys to this particular proposal. And the notion here is people who are much more likely to save more, save appropriately, stay engaged, and work towards a target if they have good advice. So if you're going to decide on a plan or use the 80-20 rule, you talk 80% of the time and they talk 20% of the time. If it's any different, walk away. They should definitely be someone who has your best interest in mind. And so this raises the notion of fiduciary versus suitable. Always get an estimate of what your costs are going to be. Ask what the alternatives are. And if they don't put something in writing, why not? Then that means that they're not really having your best interest at heart. So interestingly, through Schwab, we actually have Schwab Executive Services available to us. Mike Dickman is the individual who is our consultant. I have put up his information here, and he is a fantastic benefit to us. There are no charges for whatever it is he can do for you, and I have found him to be very engaged, very helpful, and able to guide in what you need to do. So let's talk about one marriage for a moment. So I could not decide on one movie about divorce and marriage because there are just so many. And I put up just a few of my favorites here because they really are quite meaningful. So if you think about where the US is, well, you know, we're not so bad with our divorce rate, not as high as Russia. And when you look at it, our divorce rate has actually been coming down over the last few years, which is certainly a nice finding. But there is still a divorce 1 every 13 seconds. So actually what is quite interesting to me, in the time that it takes you to recite the wedding vows, 9 people have gotten a divorce. So this is really quite telling here within the United States. 66% of divorces are filed by women, 4% in the military get divorced, 50% of children will see divorce, 43% of children are living without a father in their lives. Of course, as the number of marriages increases, the likelihood of having a divorce increases as well. And so what are the reasons? Well, there's no commitment, finances, you don't communicate well, there's infidelity, you got married too young, hopefully not abuse, but unfortunately that is the case. You're also much more likely to get divorced if your parents went through a divorce, you fight about money, you didn't graduate high school, you got married before you were 25, one or both of you smokes, you don't do the chores together, you met in a bar, and you have a friend who's going through a divorce. Now, interestingly, you're less likely to get a divorce if you're religious, if you have a college degree, if you're in a blue state, if you're happily married, if you marry after 25, and if you watch romantic movies together. Hence the movie theme for what I'm trying to show you today. So who are the people that have the lowest divorce rates? Well, agricultural workers, optometrists, and the clergy. The highest are dancers, bartenders, and massage therapists, and gaming cage workers, which of course I had no idea what that was. I do now, and it is not someone that I would choose to have a dating experience with. The lowest divorce rates are in Iowa, Illinois, and Massachusetts, with the highest in Nevada, West Virginia, and Arkansas. As you can tell, these are some of the states that have the professions we were discussing. It is about money in some senses. So if you went back to one of the celebrity divorces with Steve and Elaine Wynn, $1 billion was paid out. Rupert and Anna Murdoch was $1.7 billion. And of course, I think all of you are quite familiar with the recent Jeff and Mackenzie Bezos, where she received a $37 billion payout from that particular divorce. So divorce is always expensive. It doesn't matter what happens. It is the single most important negative impact on your finances that you will ever experience. It's a major change in housing and retirements and future income streams. So it's good to have a prenup agreement. Of course, you can do a postnup agreement, but if you start to do a postnup now, talk about being very suspicious. The average cost for a professional to get a divorce is around $100,000. And of course, since you live in California, it's going to be 50%. We are a 50-50 community property state. So half of the house, half of retirements, major tax consequence to you as well. And remember that alimony is no longer deductible, which is going to be another negative impact. One of the things that has come to my attention is people taking loans to get married. Don't ever take a loan to get married. How could you possibly bankrupt yourself in that fashion? But still, on average, $16,000 is taken for a wedding in 2019 with an average of 8% interest rate. So choose to get married later. I mean, now with COVID, just the two of you together in the living room with a Zoom meeting. No cost, fabulous. Marriage is not 50-50. Divorce is 50-50. Marriage is 100% from each of you. So you need to give it your all in order to be able to achieve a happy spouse and happy house, which is what I would like you to try and have in your overall experience. Let's go to keeping track. So in this particular case, I love the Matrix movie, but of course, do you know if you are actually supporting some organic machine, or are you really keeping track of what's going on? So let's talk about Social Security just for a moment. Will it be there for you? Well, yes. In this particular case, if you look at the balance of just under $3 trillion, with $1 trillion in, $1 trillion out, and about $3 billion in increase, it's going to be there for you, so don't worry about it. Here is a snapshot of what is present in our current 401k, and I'm highlighting this specifically rather than the KEO, since that's what you'll be able to participate in the soonest. But what you can tell from overall account balances is that on average they do quite well, just over $250,000 for all of the participants. And this is about $2.5 billion in overall assets for everyone, with 83% participating. If you break this down by overall account balances over time, you will notice that the balances clearly increase as you go up, and it's kind of nice to find yourself and where you fit into this particular paradigm. And so since I'm in that particular age bracket, I should have somewhere in the range of about $465,000 in my account, which that means you can go and look at your own balance and see if it fits. However, I would like to put this now in the context of the national averages. So if you look at where we are on average versus where you are nationally, you can tell that we are often 2 or 3 to sometimes 4 times the amount that is present in an average person's 401k balance. Now, of course, that does presuppose that they have a 401k at all. Let's look at years of participation as an alternate. Here you can see that this means how long have you been here. So you have to wait 6 months before you can begin participating. And again, depending on where you are and how you fit in, I've been able to participate for the 16 to 20 year time frame. So I should have about 446,000 if I'm the average for our overall group. So this just gives you a guide in order to be able to see where you are. Again, putting that in the context of what goes on in the nation, you can tell again that we do have a significantly greater overall balance available to us, partly because of our low expense ratio, but also because of the way in which the accounts are structured. So do you have a will or a trust? Do you have a powers of attorney, advance care directives, any of those things? It's a simple yes or no, right? This is not a, oh, I'm doing it, I'm getting around to it. That means no. So if you think about what your retirement plans are, remember that charity before an individual, younger before older, and low income before high income as to how you allocate what you're going to give to people. Determining the value of your estate maybe now is not so significant if you think about the medical school debt, but you do need to have the thought of what if something goes wrong. A durable power of attorney for financial matters, for healthcare matters, advanced care directives, a will, trust, and so forth. These are all things that are quite significant. And actually, if you look at Willmaker and Trust from Quicken, you can get that for just $84 and do it on your own if you're not a complicated individual. I'm a complicated person, so I went with someone as an attorney who did it for me and did a fabulous job. Let's talk just for a moment about digital assets. The average person nowadays has about 90 online accounts. However, I have 251 accounts, all of them that are in a database, i.e. the head. And of course, all of them are supposed to have different passwords and different login criteria. So you had better make sure that there is someone who's able to access those in an untoward event in order to be able to either stop them or discontinue them, or if there is money involved, getting the money back out. So the best way to do this is a financial records organizer, having a binder or a file system. It can be in the cloud as well that stores your important financial information. Make sure it isn't 3-ring hole punched because, of course, that does invalidate some particular documents, and have a primary with some backups. So, in fact, I have one with my brother, who is my executor, and I have one in a safety deposit box, and then one that is stored elsewhere, so that no matter what happens, let's say we have a massive earthquake here in California, my brother lives in Maryland, so he would still have copies of it, and if there are any changes, I send them to him once a year as a very nice Christmas present. Remember that the contribution limits for this year are $57,000 or $63,500 if you are more than 50. The $19,500, of course, is for the 401 with a $6,500 catch-up if you're older than 50. And, of course, $37,000 for the 100% KEO limit. I would like to end with Freakonomics, a very interesting film looking at some of the parameters that go into economic decision-making. Still, can it pass the Lester test? That is how I would like to end this particular talk, by saying, is it in your best interest? Is it something that you can explain in a few moments or less? And does it have a low expense ratio? So Lester the Investor is, of course, the way in which you can get in touch with me. Lester rhymes with several things, and this is the best one that I could choose at the time. But also remember, there are a whole bunch of resources that are available to you as well. They are highlighted here along the left-hand side. But if you would also like to read a few books, if you look at My FICO, which is an example of your FICO score, and just take the first letters of those, The Millionaire Next Door, Freakonomics, Intelligent Investor, Common Sense Investing, and One Up on Wall Street are all very informative films that may help you in coming up with a way to manage your financial future.